Grimes from Market Life, and welcome to the free video for Friday, January 24th, 2020. Let's talk about NIO. So this is a cheap stock. A few months ago, it was a much cheaper stock. So this is a stock that's basically gone from $1.50 to a peak of $5.50 in about 4 months. Trading a cheap stock like this is different. It's different than trading, say, a large cap, different than trading a market stock, different than trading an index. The biggest thing you need to do is not chase. In other words, this FOMO, fear of missing out. If you rush into a stock like this when it's moving, you will find over and over it collapses against you a couple points the next day. And you might even be right a few weeks later, but you couldn't take the pain, so you got out. So you don't want to just kind of be randomly banging in and out of a stock like this. What you want to do is have a clear plan. And I think in this case, what we can look for is, and also don't expect like super clear patterns. You know, stocks like this, whatever you think is a reasonable pullback, whatever you think a pattern should look like, it might very well overshoot and be fine. That's just the nature of a cheap, volatile stock that a bunch of people are trading. But I would look for it to kind of hang out here in between the $4 and $5 range. Give it a few days to stabilize. You probably don't have a trade at the end of this week, maybe beginning of next week. And then you can look to either buy a position in the stock if it breaks to the upside. You can also think about options, but this is very, very, very important. Implied volatility, which is just a way to measure how expensive the options are. Implied volatility is crazy. You'll be paying over 130, 140% implied volatility. And yes, you know, that can make sense, but very, very expensive options. You're much better if you can spread some of that. So looking at a call vertical, one thing to think about, and again, I don't think it's quite time, but look out to the March 4.5 by 6 call vertical. So that's buying the 4.5, selling the 6. You got to sell a lot of those because they're relatively cheap. But if you sell, if you buy 10 of those spreads, you're looking at risking about $500, maximum profit potential about $1,000. We'll check in on this trade next week and see how it holds together. But I would put this on your watch list. If you want to be super aggressive with it, there is a trade you could execute this Friday. You could buy above $5 here, but the only way you should hold that is if you get the confirmation of a strong close at new highs. You do not want to be the sucker that pays $5.25 and then it closes at $4. That's a very bad trade. So this is legitimately a trade where you should buy and look for immediate follow through. That's all we have here to end the week. If you like the video, give us a like on the video, subscribe to the channel, tell all your friends and family members, everybody you know, to subscribe to the channel, and go check out my work. You can see my work at marketlife.com, also my blog, adamhgrimes.com. I will see you back next week. Thank you very much.